This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rally falls apart. A 280-point gain in the Dow Jones Industrial Average evaporates. What's behind one of the biggest downward swings for the blue chip index in years?
Payday. New reports show wages are rising. Yes, rising, along with job openings. Has the missing piece of the labor market puzzle been found?
Cash back? Is Apple getting ready to give billions back to its shareholders in the form of dividends and buybacks? We'll speak to the analyst who says yes. All that and more tonight on Nightly Business Report for Tuesday, January 13th.
Good evening, everyone, and welcome. If all you looked at today were the closing numbers on Wall Street, then you really missed it. The Dow ended with a piddling 0.2% decline on the day, not much at all. But between the bells, it swung 425 points from peak to trough in a wild, volatile trading session. At one point, up 282. At another, down 143. For the first time since 2009, the Dow moved from being up 1.6% to ending negative on the day. Pick your reasons for the volatility. The bulls liked Alcoa's earnings report yesterday, some solid Chinese trade data today, but the bears then took over on some troubling technicals, word that Germany may be balking at the size of stimulus envisioned by Europe's central bank, and, of course, oil. It resumed its problematic slide today as Brent crude briefly traded at parity with domestic oil. Here's how the major averages ended the day, and again, those numbers deceive. The Dow finally closed 27 points lower, the Nasdaq down 3, and the S&P 500 was off by a mere 5 points. U.S. oil closed 18 cents lower at $45.89 a barrel, and actually turned positive in after-hours trading for a while. Benchmark Brent settled down 84 cents, closing at $46.59 a barrel. In the bond market, the yield on the benchmark 10-year note dipped below 1.9% before closing really right at that level. So what happened? What caused the huge reversal in stocks today? Bob Pisani looks for some answers.
What a day. Whew. At one point, the Dow was up over 280 points. Then in the early afternoon, it was down 140 points, and it ended down about 27. What happened? There were a series of disappointments right after the open. First, energy stocks were, again, a drag on the markets. Second, Alcoa, which had a decent earnings report, turned negative early on. Then about 11:30 a.m. Eastern Time, homebuilder KB Home gave disappointing commentary for 2015. And the whole home building complex fell apart. Homebuilders had been leaders until today. Then in the early afternoon, there were a series of very quick down moves, which saw the Dow move over 250 points down in about an hour. That's a big move for an hour. And it indicates that the market is starting to price in more risk and a potential earnings slowdown. One thing to watch is the poor performance of financials, which were among the first sectors to drop off today. We're going into earnings reports for big banks this week, and it's fairly common to sell off into those reports. Bank of America, PNC, Comerica, and SunTrust were among the weakest banks. All of them are reporting earnings this week. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And we'll have much more on what to expect from those bank earnings a little later in the program.
Despite today's stock market losses, there was some good news about jobs and wage growth in particular. The latest survey from the National Federation of Independent Businesses found that optimism among small business owners is now at an 8-year high, and that more owners plan to hire more workers and increase their wages. The Labor Department also had encouraging news in November. Employers advertised the most job openings in almost 14 years, nearly 5 million posted jobs looking to be filled.
Well, health insurance giant Aetna is doing its part for wage growth. Starting in April, the company is increasing its minimum wage for employees to $16 an hour. The move will boost the pay of nearly 6,000 workers, with some seeing a raise of 33%.
But will all of these signs that we're seeing today translate into wage growth around the country this year? Let's find out from Mark Zandi. He is the chief economist with Moody's Analytics. Good to see you, Mark. Welcome.
Thank you so much.
Let's start, first of all, with the wage growth. One assumes that when you start to get wage growth, it means that the economy is on much more solid footing. Is that what's happening here?
Well, wage growth has been about 2%, the rate of inflation since really since the recessions for most of the economic recovery. We haven't seen an acceleration, a meaningful acceleration yet, but all the ingredients are coming together for a pickup in wage growth. I anticipate that we'll see that in the next few months. Certainly by this time next year, wage growth will be substantively higher than it is today.
So why, Mark, did the number in the Labor Department's employment report out last Friday come in negative, that there wasn't much, if any, wage growth in the most recent month? It was something that everybody seemed frantic about on Friday.
Mm-hmm.
Yeah, it's a puzzle, Tyler. I'm not really sure. I mean, I don't believe it. I think the data will be revised. There's a lot of technical measurement issues. The month of December is particularly squirrely. So I would just throw it out. I just don't believe it. I don't think wage growth is decelerating. I don't think it's accelerated to a significant degree, but I think the numbers we got on Friday are not telling the true story of what's going on.
So, Mark, does this change the Fed's timetable in terms of perhaps moving up interest rates, or because it's not necessarily a trend, does it not have an impact on the Fed?
I think the Fed is really focused on wage growth. And if wage growth accelerates, as I would anticipate in the next few months, then by mid this year, they will begin to raise interest rates. I think that's their forecast. I think that's consistent with what they're thinking. Now, if I'm wrong and we don't get that pickup in wage growth in the next few months, then I think the Federal Reserve will delay its first rate hike later into the year. It's a key necessary condition for rising interest rates is rising, accelerating wage growth. Until we get that, I don't think the Fed will actually pull the trigger and raise rates.
Why, Mark, has wage growth been so peskily slow in recent years, and why now do you think it's going to pick up?
Well, we have a lot of slack in the labor market. I mean, the unemployment rate peaked at 10% back in late 2009, early 2010. It's been declining ever since, but it's still, we're still not back to full employment. The unemployment rate is 5.6%, which is much lower than it was, but full employment is probably closer to a 5% unemployment rate. So there's just all that slack keeps a lid on wage growth. Now, we are creating a lot of jobs. We created 3 million last year. We're on track to create about the same At that pace, that slack will be absorbed by this time next year. We will get to a 5% unemployment rate. That is full employment, and we will get wage growth. So if history is any guide, by this time next year, we should have a substantive pickup in wage growth, and the Fed should be tightening interest rates.
All right, we'll leave it on that optimistic note, Mark. Thank you. Mark Zandi with Moody's Analytics.
Thank you.
Here's something you don't hear often, a budget surplus, federal budget surplus. It may only be for 1 month, December, but thanks to an improving economy and stepped-up tax receipts, the Treasury posted a $2 billion surplus last month. Don't strike up the band just yet, but this does put the federal budget shortfall for the calendar year 2014. That's the calendar year under $500 billion. That's the smallest since 2007, before President Obama took office.
A stronger U.S. economy and tumbling energy prices may not be enough to help economies in the Eurozone and in emerging markets. Just today, the World Bank lowered its outlook for global growth this year to just 3% from an earlier forecast of 3.4%. Here in the U.S., the World Bank increased its growth outlook for 2015 to 3.2%.
Now to earnings after the bell from the railroad giant CSX. Fourth quarter profits of 49 cents a share were right in line with analyst forecasts. How about those analysts? Revenues topped $3 billion, slightly beating estimates, helped by an 11% jump in coal shipments, as well as gains in intermodal and merchandise shipping. The company also says it sees double-digit earnings growth in 2015, and that sent shares initially higher in late trading. But the big issue for CSX and other railroad operators is the sharp drop in oil prices. Morgan Brennan explains why.
Plummeting energy prices have been creating all kinds of pros and cons for railroad operators, making this earnings season especially important.
First quarter earnings should continue to be very healthy for no other reason than the weather so far has been relatively mild, at least relative to last year's miserable winter. So they have easy comps. Longer
term, however, there are three major ways railroad operators could feel the effects of falling energy prices. The first is oil shipments. A fast-growing business since the fracking boom started, crude carloads have surged more than 2,000% since 2006. So far, those volumes are still increasing. What may slow down this year is the volume of fracking materials like sand and steel as new oil production begins to ebb. Still, analysts note this is just a fraction of overall rail traffic. The second factor, cheaper fuel, one of the biggest costs for operators.
The largest consumer of diesel fuel in North America is the Union Pacific. So we'll see diesel fuel costs fall. That'll certainly help their financial statements. They're also collecting fuel surcharges on last month's price of fuel, so that helps. The yield is still good. The cost is down. That should boost profitability in the current quarter and the next couple of quarters.
But lower diesel prices also make trucking more competitive, and that could pull some intermodal business to road from rail. Third, natural gas has tumbled as well, and that could tamp down demand for coal, which has experienced something of a rebound, as utilities have restocked supplies after last winter's harsh weather. That could create a headwind, since coal, despite a years-long slide, remains one of the biggest businesses for the railroads.
Nonetheless, a strengthening economy will mean more goods moving across the country in 2015, from autos to building materials to food. So while plunging energy prices could impact this industry, experts say the railroads are still on track. For Nightly Business Report, I'm Morgan Brennan.
Well, earnings season will really heat up this week as the big banks post their latest results. Tomorrow, Wells Fargo and JP Morgan are expected to report their quarterly numbers. Later in the week, we'll hear from Bank of America, Citigroup, and Goldman Sachs. Kayla Tausche is with us now to talk about what investors are going to be looking for, because the financials are so key to the market going forward.
They're really the barometer of the overall economy, Sue, and it appears that the fourth quarter will show a tale of two businesses. On one side, the Main Street-facing businesses of Wall Street are going to do really well. Lower oil prices and continued low interest rates will help demand for loans. Consumer spending will be up, and people will use that extra money to pay off their bills. But ironically, the Wall Street side of the business, trading activity, some of the IPO activity, and some of the more high finance areas of the business won't do so well because of all the various macroeconomic parts of the market that will affect it.
I thought trading was pretty, I mean, there was a big volume in the stock market last year. There was not as much volatility, but certainly a lot this year. Why is trading suffering?
You would think that more volatility would mean more volume in the market, and it does, but what executives have been saying as recently as last month is that a lot of this trading has become electronic trading, more each quarter, and they don't make as much money off of that. It's cheaper for the traders to execute, but it's not as much revenue for the banks.
Margins aren't as good.
Exactly.
Basically.
What about the low interest rate environment? That hasn't helped them either.
No, and that's the single biggest thing that they're hoping for in 2015. Everybody thought in 2014 that would be the year that we would, if we didn't see the Fed raise interest rates, then that would be the year that at least yields would start going up and they would make more money off of loans that they were making to borrowers. That didn't happen. So they're really pinning all of their hopes on 2015 as a year where interest rates and yields rise and their overall business model becomes a little bit more profitable.
Are the big banks' legal problems behind them, or are there still more fines to come?
Not even close. You read my mind, Tyler. We actually already have word that Citigroup, as of last month, it announced that it was going to be taking a $2.7 billion legal charge related to alleged manipulation of currencies and benchmark interest rates. But Citi's not alone. They're just the only bank that's pre-announced that. So we could see some line items for some of these banks that are big ticket items. It's just become impossible to predict.
All right.
Kayla, thank you so much. Appreciate it.
And still ahead, what is Apple? What is Apple going to do with all of its cash? It can buy iPhones for everyone.
Everybody, all around.
Come on. The answer, according to one analyst, is something shareholders will want to pay close attention to. We will talk to that analyst next.
Some bad news coming into focus for GoPro. Apple has been granted a patent for a wearable camera that can be mounted on ski helmets and surfboards and other sports gear, just like GoPros. With the iPhone maker planning to enter the action camera market, shares of GoPro got hit very hard today. They tumbled a full 12% on the trading session.
Well, it was a different story, Sue, for Apple. Our next guest helped push shares up nearly 1%. With his upgrade from neutral to outperform today, he thinks Apple will announce a new $200 billion plan to buy back shares and raise its dividend, and maybe do it as soon as April. And the iPhone 6 sales will continue to push the stock higher, he says. He's Kulbinder Garcha, Managing Director and Global Communication Analyst at Credit Suisse. Mr. Garcha, welcome. Good to have you with us. What makes you think that Apple, which has already returned so much capital to its shareholders, is now going to go for return an even bigger slug of it?
Well, a few things here I think are worth considering. Apple probably will arrive at April of 2015 with what we think is going to be around $140 billion of net cash. Now, that's more net cash that Apple will have at that stage than when they first implemented their capital return program. Then 3 years ago, that was about $100 billion. So if it was excessive, then it's clearly excessive now. Also, the business is fundamentally solid. This company is producing, we think, a sustainable $50 billion of free cash flow a year. So we think now is the time, on the 3-year anniversary, as they come into the final year of their capital return program, to meaningfully up it. What we think they will do is return about $200 billion to shareholders over the subsequent 2.5 years, which presents in itself a major cash return coming forward.
They're really staggering numbers when you think about them, and you think sales is one of the ways that it's going to be driven forward, specifically the iPhone 6, and you think people are going to ante up for the more expensive version.
Yes, one of the things that we're seeing that's been surprising has been not only just the strength of demand in the near term. We're now thinking that over the next calendar year, iPhone volumes will be well above 200 million units, growing 20%. But also what we're seeing is a mix within Apple's business towards higher capacity storage devices, as in the 64 gigabyte and the 128 gigabyte devices, and also more demand for the iPhone 6 Plus. Given that Apple sells those at a premium in terms of selling prices and in terms of margins, that means gross profit dollar growth in the iPhone business could expand by $18 billion over the next year, or by around 40%.
Boy, that is just an amazing forecast there. What is your price target on this stock, Mr. Garcha?
Our price target on it now is $130. What I would highlight is that we think that could even prove conservative, as we don't assume any scale effect on gross margins. We've got relatively conservative estimates for the Apple Watch. And additionally, we don't assume that Apple announce any new products and services all over the medium term, which are probably quite likely.
So you're actually underestimating, compared to the street anyway, the sales of the other devices, the watches and the like. So perhaps you get a surprise on the upside out of that.
Yeah, I think as we go over the course of this year and into next year, we will see that. We think our $10 of EPS power for Apple for calendar year 16 could in fact prove conservative.
All right, Mr. Garcha, thank you very much for being with us tonight. We appreciate your time.
Thank you.
Kulbinder Garcha with Credit Suisse.
MetLife announces plans to sue the government, and that's where we begin tonight's market focus. Last month, regulators designated the life insurance company as a systemically important financial institution, or too big to fail, meaning it will be subject to stricter guidelines from federal overseers. MetLife says it will file a lawsuit to overturn that ruling, and the CEO explained why.
We think it's the right thing to do to appeal this decision under Dodd-Frank for the benefit of our consumers, our shareholders, all of our stakeholders. Our belief is that this action could lead and is likely to lead to higher costs for middle-class consumers of insurance products without any additional safety being provided to the system.
Well, shares still fell better than 1% to $49.81. And it was a rough day for shares of KB Home. The home builder said it expected a significant drop in gross margins in the current quarter. Fourth quarter revenue actually came in better than expected. Still, KB saw its shares plunge 16%, and the other home builders like Lennar, D.R. Horton, Pulte Group, and Toll Brothers all fell in sympathy. The state of California is looking to suspend Ocwen Financial's mortgage license. The state says the company failed to turn over documents that shows it complies with the state's homeowner protection laws. But Ocwen says it has been cooperating. The stock rose on Ocwen's cooperation comments, which came after the bell, but fell back again when the state came out saying Ocwen hasn't been responding to its requests. Before the close, shares were down by 36% to $7.78.
Well, Goodyear Tire hit a few bumps in the road in 2014. The company had to lower its full-year earnings guidance because of a stronger dollar, demand weakness in Europe, and since winter weather has been warmer than expected, fewer snow tires, I guess. Shares dropped 7% to $26.05. Today, the competition heating up now once again between the aircraft makers Boeing and Airbus. Boeing did manage to top Airbus in deliveries to customers for the third year in a row last year, but Airbus flew ahead in the number of future orders. Shares of Boeing up a fraction. 131.17 was the close there. Airbus trades over in Europe. And shares of Amazon were higher on news that the company has snagged Woody Allen to write and direct his first TV series. Citi also upgraded the stock to buy, citing strong revenue growth and improving margins. Shares of Amazon up more than 1% today to $294.74.
Well, it kind of seems like the holidays just ended, but despite strong sales, retailers are already assessing how the U.S. consumer is doing as we head into this new year. Courtney Reagan has more.
As retail resets for 2015, the big focus is the state of the consumer.
Every year's a challenge, but I am thinking again more optimistically, and hopefully we'll leave the year with a little more money in the bank than I had the year prior.
At the National Retail Federation's annual Big Show, former Federal Reserve Chairman Ben Bernanke said while many in the middle class are still facing financial pressures, he hasn't seen the economic backdrop for the consumer this strong in almost a decade. Here at the ICR Exchange Conference in Orlando, the tone is quite bullish. Companies from restaurants to retail are feeling good about the U.S. consumer, fueled in part by lower prices at the pump, which KeyBank's Ed Yruma estimates could put an additional $800 on average back in consumers' pockets this year.
Improved consumer confidence, lower gas prices, having some disposable income greater than their monthly budgets, I think that's a helpful thing to the consumer.
But the enthusiasm isn't without some caution.
It's been a bit challenging for the finish line over the last couple of months, but we'll be back strong. We focus on product and we focus on the customer.
Not all consumers are feeling flush, forcing retailers to work even harder.
I think it's going to stagger along as it is now. People are going to make money on the stock market, and the common man isn't going to do much better because those family wage jobs are gone.
There's also continued concerns of what the future is going to be, particularly around jobs and particularly around, income growth. So really the way we have to be thinking as retailers, if the consumer is going to spend and if they are getting some additional incremental income, how are you going to be the person they spend it with?
How do you do that? You make sure that what you deliver is what people want.
Easier said than done for some retailers. For Nightly Business Report, I'm Courtney Reagan.
Coming up, all in the family, the one thing most family-run small businesses need but don't have. That's next.
Some hope for foreign workers looking to get full-time, high-tech jobs here in the U.S. Republican Senator Orrin Hatch of Utah introduced a bipartisan bill today that would increase the number of high-tech work visas issued and loosen up some restrictions on U.S. firms that are looking to hire foreign specialists in science, tech, and engineering jobs.
The nation's largest public pension fund doing a little crowing tonight about how far its funding levels have improved since the financial crisis back in '08. CalPERS, the California Public Employees Retirement System, says its finances significantly improved in 2014 as it surpassed $300 billion under management for the first time ever.
And finally tonight, a look at succession plans at family-owned businesses and the surprising number of mom and pops that don't have one. So how can those owners keep their businesses all in the family? Kate Rogers has more.
Dennis Groth started his family business, Groth Vineyards and Winery in Napa Valley, in 1982 and continues to run the show into his golden years. His daughter Suzanne will one day take over the reins, but like many parents, the former accountant isn't quite ready to let go.
I'll slow down. I'm 72 years old now, and I still like what I do, and my daughter hasn't asked me to leave yet.
Groth doesn't have a formal succession plan for his business, but he isn't unique. The U.S. Family Business Survey from PricewaterhouseCoopers finds nearly 75% of family-owned businesses don't have a succession plan for senior positions in their company. What's more, nearly 60% will stay on at their business longer than planned to ensure a smooth transition, something that PwC's Alfred Peguero calls sticky baton syndrome.
There's some tendencies of the previous generation or the current leaders to kind of hold on and maybe want to stay involved, maybe want to have some influence. And it may have something to do with the money side and the wealth side, but I think it has to do more with the emotional side.
According to U.S. Census data, nearly 1/3 of small businesses in America are family-owned or operated. And these true mom and pops, they're feeling decidedly optimistic in 2015, with 79% telling PwC they're expecting steady growth over the next 5 years. It's not just family businesses feeling optimistic. The National Federation of Independent Businesses Optimism Index also hit its highest level today since October of 2006, with more businesses planning to make capital outlays, hire, and expand. Groth echoes that sunny outlook, saying the wine business has been on a tear post-recession thanks to a more upbeat consumer. It's so good he's hesitant to leave.
It's the best thing I've ever done in my life, and I love it.
For Nightly Business Report, I'm Kate Rogers.
That is a great job.
Pretty part of the country, boy.
Oh, it's beautiful.
Golly, is it nice out
Miss
there.
it. All right, that's it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody, and we will see you back here tomorrow.